Crazy. Oh, stop. Stop. Oh, you're embarrassing me. Stop. Thank you very much. Thank you very much. Okay. All right. Thank you very much, everyone. Mr. Producer, thank you. All right. I've been waiting all day to do that. I found this new toy. So expect to hear more of this stuff in the future. Okay. Welcome, everybody. Happy Sunday. I hope everybody had an awesome weekend. I did. It was really, really good. And I am ready to go back to work. The futures are open, and we're going to talk about what the futures are doing right now. We're seeing a big gap down in the E-minis. We'll go over this in a little bit further detail. I think we're going to rally here. We're going to rally. And I'll tell you why in a moment. We're going to go over the whys behind. I believe that this market is going considerably lower. I have a lot of headlines to get through. We're going to talk about some calls that I made last week. We'll see how they played out. I'm also going to go over some calls that I made back in February of 2022. And I warned about equities in Bitcoin. And I'm going to play that for you just so you get a feel. If you're not familiar with me, then get a feel for my calls and my predictions about what would happen to this market. And we're going to be talking about where I think it's going next. So what I want to do is make sure, my audio is working. And of course, I am going to share my background or the screen share. And we'll let people populate in here. Let's go over some comments. Franklin, Bob and crew, hope you had enjoyed. Yeah, it was a really good weekend. Same to you. Hope everybody had a really good weekend. Weather was beautiful here. Really, really good weekend. Hello, Gringo. Audio is very good. Good to hear. Thank you very much. Pete, hello, sir. Joe Gardner, top of the evening to you. Trader Isaac, got your message. Thank you. Danny, hey, Bob, rally sounds good in the short term, especially uranium. Uranium had a really, really good week. We're long of uranium. I'm expecting higher highs on uranium in the coming days. So let me share my screen before I forget to do it. And you guys remind me like 5 minutes in, and I feel embarrassed. So let me be proactive and let's get that done. Get it in the rearview mirror. And there we go. Okay. So let's talk about the futures action. We have the E-minis, which have gapped down. Now, one thing I want to point out, this is a 15-minute chart. These will all be 15-minute charts unless I say otherwise. Now, the whatever index you want to take a look at, equity index you want to take a look at, whether it be the Russell 2000, the Qs, the E-minis, the mid caps, whatever, the Dow, all left the day on Friday very, very sold on an intraday basis. So you can't be surprised if even with this gap down that we get a rally here, at least maybe into tomorrow morning, into maybe get a turnaround Tuesday. I'm having a hard time thinking that we're just going to go straight down from here. And frankly, I'm hoping that we don't. I'm going to talk about the Qs in a moment. We added to our short position of the Qs at the close on Friday. It's going to be working for us right now. But again, I don't think it's going to hold. I think we're going to rally. And on that rally back up on the Qs, I want to lean in more to the short side. I'll talk to you about the strike prices that we're looking at to add to our shorts on the triple Qs. So we have E-minis, S&P 500 down over 0.75 of a percentage point. Small caps, they're down about a percentage point. But note, just like with the E-minis, very, very oversold on RSI. I mean, this is only a 15-minute chart. So if you want to take a look at a 4-hour chart, yeah, we have more downside to go here if we wanted to. So speaking from a very short term, 14-minute time frame, I think we're going to get a rally at some point in time overnight. Will it last into tomorrow morning? Might they sell any rally that we see? Sure. In all probability, they're going to. We'll talk about the whys behind it in a moment. We did S&Ps. Let's go to the NASDAQ. Big gap down here. NASDAQ, of which we are short. These are the NASDAQ 100, aka the triple Qs. NASDAQ is down worse than the small caps. So we're seeing a major move lower here. And we appear to be weakening. But again, we're oversold 15-minute time frame. We may get a counter trend move. Let's take our crayon out here. Let's set up an alert. And we're good to go. All right, so we'll see what happens here. Remember, this is very thin volume. Not much data to go by. This is just a continuation sell-off from Friday. I'm not a bull by any stretch of the imagination, despite the fact I'm saying we're probably going to get a rally back here. I am no bull. So let's continue on. We've gone over equities. Let's take a quick peek at where the yield is moving, the 10-year yield, and the 10. Oof. This is a problem. Now I understand why equities are following through to the downside on the session. Now, if you go back to Thursday Night Futures Live, and frankly, any live stream I've done over the past, I don't know, 3 months or so, I have been warning about, even longer than 3 months, warning about yields over 3%, especially when it comes to tech stocks. And case in point, take note that the triple Qs are the worst performing equity sector this evening, while yields are moving up higher. There's a reason behind that. Technology is extremely expensive. EPS growth is slowing, even on the FANG names. So when you see yields moving up higher, a Federal Reserve which is speaking hawkish and threatening to weaken the economy further, that's only going to hurt earnings more, making stocks more expensive, allowing more room to the downside. I'm not here to blow sunshine up your keister. I'm not going to do that. I'm telling you the reality. You could check in with CNBC to have unicorns and pixie dust. We're not going to do that here. The reality is that the 10-year yield is moving up higher. We're up over 0.75 of a percentage point. Inversely, you're seeing the Qs down over a percentage point. It makes complete sense. And these aren't even new weekly higher highs. To do that, what I want to do is I want to go to a weekly chart. This is last week. And it was just shy of, there we go. We're good to go. Now, if yields pull back, equities can rally, right? So it's simple as that. This is not overly complicated. Let's go to comments. TZ Burton, good evening. Bob, still afternoon on the left coast. Good afternoon, TZ Burton. I got your message as well. Thank you for that. Yeah, I'm not sure what's going on with the subscriber growth. It should be higher, but I don't know. Maybe YouTube is shadow banning me or something. I don't know. It's crazy. Louis, how are you, sir? Good evening. The lovely Trish. Hello, Trish. How are you? Larry, well known that men who wear Ralph Lauren polo shirts are more likely to cheat on their only when I'm live. Thank you for that, Larry. I appreciate that study. Devin. Hey, everyone. Hello to you, Devin. Patrick. Hello, sir. Devin, thoughts on oil? Was surprised Friday it held up pretty well. Oil's breaking out. It broke out on a weekly time frame last week. It's going up higher. Yes, tap the like button, please. Thank you, everyone. Yeah, thanks for that, Joseph. Like, subscribe. If you're new to technical analysis, I got one eye on the 10-year yield here. If you are wondering what the phrases I use are, the bearish reversal, bearish engulfing, bullish key reversal, 5-part video tutorial below, free, and you'll get to learn that terminology and my top 5 favorite candlestick patterns. All right, let's continue on here. I want to take a look at the dollar. Now, the dollar had a very, very strong week last week. You bought a new truck. What kind of truck, Pat? You got to send me a picture. Unless you already sent it to me and it's on the text. Congrats, brother. This is not the dollar. What happened to my dollar? The dollar is gapping up here. All right, so this is going to be a problem for certain commodities, some more so than others. Gold is probably not going to like this, even though gold had a nice rally off the lows on Friday. We did put in a new intra-week higher high, 52-week higher high last week. We didn't close there, but this gap up higher, I have to say, is not surprising to see on the dollar. And this, again, is not good for your multinational large caps. It makes their products more expensive to buy overseas. I'm almost nervous to take a look at gold right now, but let's take a look at gold. Not bad. Not bad at all. So gold opened down, gap down, only to reverse. This is a very bullish chart. I don't know if it's going to hold up, but it looks very, very bullish. And if you pull back on gold to a 4-minute chart, a 4-hour chart, what we did on yeah, this is happening. This is happening. Gold broke out on Friday afternoon on a 4-hour time frame. So we had, this was the morning session on Friday, hammered, but we held support. The afternoon 4-hour bar tested support, then broke back out above this upper band of resistance in green. What we're doing right here and now, this session, is that we've pulled back yet again, tested that support level, and we are now positive on the session. And we're at 17.50 the ounce. So, it's not a big move up or down. It's the type of move that it is. And it's very, very bullish. We'll see whether or not it holds up here, because if the dollar really skyrockets higher, it's going to be very, very difficult for this to play out in a bullish way. Let's check out silver. Silver not as lucky to have the same type of price action. It's down about a 1/4 percentage point. You did have a bounce back on Friday afternoon, but really nothing technically significant. We did open up higher. Let's go back to a 15-minute chart to stay consistent. We did open up higher, and we faded off the highs of the session. So what I want to do here is draw another alert. And we're good to go. All right, let's stick with the commodities theme. Obviously, we need to take a look at natural gas. We need to take a look at oil. We need to take a look at foodstuffs. So beginning with light sweet crude. I remember seeing it earlier. Where is it? Must have got bumped. Light sweet crude. There we go. Light sweet crude is down a little over a third of a percentage point. Nothing technically exciting here. If you want to make the argument that we have an intra-period, intraday head and shoulders setup, you can make that argument. And it looks like this. Here is your left shoulder. Here's your head. Here is your right shoulder. And we are putting in lower highs and lower lows. So let's take our crayon out. I say that if we break down below this support level here, we're going to break 91.25 the barrel. And if we do that, that should be bullish for equities. And that might keep me from leaning into the short side. Because remember, it's really, yes, it's the supply chain that's driving inflation, but oil is a huge, huge component in not just the headline CPI, even when they back out food and energy out of the number and they come out with the core CPI. You got to remember that there is so many derivatives that come from oil into manufactured products that it makes its way into that core CPI number. So oil can never be discounted. It can only, you got to respect oil and the impact that it has on our economy, the global economy. Sticking with oil, let's stick with derivatives for a second. Distillates. I should have gasoline up here. RBOB. RBOB prices are down about a half percentage point on the session. Let's see how we closed out the week last week. And no new weekly lower low. We're in no man's land right now. Last week was a pretty significant breakdown on gasoline prices. As a matter of fact, I want to create an alert here. That's not accurate. Okay, that's better. So I want to know if we recapture this support level. If we do, the probability of gasoline breaking out of this downtrend is very, very strong. Let's take a quick peek at home heating oil. I've been warning about home heating oil for the past several weeks, and it only continues to move up higher. And we do not have, is this last week or this week? It's this week. We do not have a new weekly higher high, but it's clear that we have a new trend that is developed, and it's to the upside. And the reason why I'm putting up so many alerts here is because if you start seeing breakouts on home heating oil, on not even so much home heating oil, it's not as widely used as natural gas, but gasoline certainly, natural gas, food prices, you start seeing moves to new higher highs. And that's going to be an alarm bell for equity traders because they know the Federal Reserve is going to have to be proactive. They're going to have to be, not the proactive. That's the worst term to use for the Federal Reserve is proactive. They're going to have to speak hawkish, and that'll keep equities down. Okay. And we're good. Yoga Mac, welcome, my friend. Hope you had a good weekend. Yeah, gasoline prices are down pretty much everywhere. It's a question of just how long. You got to remember that the Federal Reserve, excuse me, the Federal Reserve, the Biden administration has dumped tremendous amounts of oil onto the market. And, frankly, let's go back to light sweet crude for a moment. For the past few months, they've been dumping the strategic oil reserve out into the market. We're at the lowest level on the strategic petroleum reserve since 1985. And oil is pretty strong. It's holding up there. So what happens when they stop dumping oil onto the market? You got to think that oil is going to press back up higher, especially if the dollar begins to roll over. So I worry about how long gasoline is going to stay down. Let's move on. Sticking with commodities, we'll go to agriculture. We're going to stick with we spoke about this last week. We're going to stick with the majors: soybeans, corn, wheat. And last week saw a very, very strong week on soybean prices. Soybeans are a very essential staple in the diets of at least Americans, and not many people realize that. It's just not Japanese edamame. It goes into a lot of different foodstuffs. So soybeans, very, very strong price action here. We do have, stiff resistance above. But we're certainly looking a lot more bullish than what we did a few weeks ago. Trader Isaac, Bob, on shorting Qs, would you want to see failure on move to last week's highs, or just green open Monday and short on a break of Friday's? Okay, so the strategy, I'm going to go over this in a moment. So stick around, Trader Isaac. I'm going to go over how I plan on leaning in higher to the short side on the Qs and going from a hedge and moving more towards a directional bet against the Qs and their probability of them going lower. So I'm going to go over that in a moment. Stick around. I'll have the chart ready for you. We'll talk about it. And good question. Let's just wrap up the futures and then we'll move on. Wheat prices. I know Trader Isaac's big on wheat prices. Larry's big on wheat prices. And wheat prices are stabilizing. And you could argue that what we're doing here is that we're wedging out. We're creating a wedge formation. And all we're really looking for now is either a confirmation breakout or breakdown, one of the two. But in looking at this chart and looking at the amount of farmland that is taken offline in the Netherlands, the fact that you have droughts all around the globe, I can only think that wheat prices are going to press up higher. And now you even have the Amish community under the hammer of the federal government, at least in terms of cattle. And it's horrible what they're doing over the Amish community in Pennsylvania. What else do we need to go? Did I go over corn? I don't think I did. Corn. Let's just check back really quick on gold. Okay, it's flat. Corn prices. Oh, I didn't go over natural gas either. There we go. Corn. I like to do oh, look at this. Corn's looking solid. Wow. Corn's looking good. This is a 4-hour chart. It's going up higher. We're stair-stepping higher here. here, climbing the wall of worry. It's going up higher. Beautiful, beautiful candlestick last week. Next price target, 791 spot 79, the bushel, or however they measure corn. I think it's the bushel. So let's go over and take a quick look at natural gas. We're long of natural gas. Yeah, I'll just bring it up. NG. Natural gas is, wow. This is a weekly chart. This is not reflective, I don't think, of this week. It is reflective of this week. Wow. Big gap up higher here on nat gas. Big gap up higher nat gas. This is a 3.15% move on natural gas. This is like a 2 standard deviation move. A very powerful move, especially if it holds. And it's the reason why we've been buying natural gas BOIL. Let me rephrase. We have an options position open on BOIL, which is a leveraged ETF putting you long of natural gas. Now, we are the underwriters. We are the financiers of those options trades. So if you're going to go buy the options, you're buying them from me. So we sold deep out of the money puts. We sold deep out of the money calls. I'm not worried about the put side so much, but I'm worried about a move. I have been worried about a move like this on natural gas threatening my call side. So what we did is we started building a long position to hedge that naked call position. And I'm very glad that we did, because this is a powerful move. This is a message. So despite all of Powell's comments on Friday, it doesn't matter. Energy prices want to go up higher. Let's circle back to the dollar really quick here, and then we're going to get started. Dollar a little bit. It's still strong, but a little bit of a fade off the highs. A little bit. I'm hoping for this to come in. Okay, let's get to it. All right. So back in February of 2020, I was invited to do a presentation with a bunch of other really, really good technicians, Rob Smith, Sarah Stratt, what's his name, from All Star Charts. And this is what I had to say. Everybody was fairly bullish at the time. And this is what I had to say. Capital flight out of the U.S. will go into commodities, international value stocks, and yes, Bitcoin. It'll drive Bitcoin a lot higher. Let's do a top-down approach on Bitcoin from where we are at current. Because remember, I have a short-term bear thesis on Bitcoin, and for the only reason is because I don't think yet that traders appreciate the fact that the Federal Reserve is not serious about raising rates. We've shown the correlation between the CPI and Bitcoin. They trade lockstep. The only reason why Bitcoin is selling off hard at current, or has sold off hard recently, despite rising inflation, is fear, a risk-off environment, and two, Bitcoin traders are concerned about the Federal Reserve actually being serious and getting inflation under control. Because if the CPI rolls over and there's a correlation to Bitcoin, what happens to Bitcoin? It's going to roll over as well. I don't think that's going to happen. So let's talk about the macro view of Bitcoin. Let's face it, this is a heck of a run here. Gorgeous run. It is not done. We are still in an uptrend channel. We still may, and that's a capital May there, we may continue up higher, But a couple of things are bothering me here. Monthly SOS, lower highs. The month is not over yet, so this could change. Maybe we'll hook back up, but I doubt it, because this includes January now. It's asking a lot to have these hooked up right now, because we're putting in lower highs and now potentially lower lows. All right, so the point here was that we were picking off back in February of 2022 that Bitcoin was weakening up, and so was the equity market. And I didn't catch flack, but there was a little bit of friction about that call. But sure enough, taking a look at the chart of Bitcoin, this is when I did that commentary back here. And the signals that we were picking off on Bitcoin back then, and if you want to watch the entire video, I'll pop the link in there for you, and you can watch the whole thing at your leisure. I don't want to play the whole thing now and bore you to tears. But earlier in the presentation, I showed how Bitcoin was correlated with equities. I was bearish on equities, and I was worried about Bitcoin rolling over along with equities. So the point I'm trying to make here is that back in February of 2022, a lot of people were still bullish on Bitcoin, bullish on equities. I was not. And I was warning that the Federal Reserve was not going to do their job. And to draw the picture as to the fact that the Federal Reserve would not do their job, the very definition of inflation is, in short, money supply. Federal Reserve printed notes, IOUs flooding the market. We have, since February, when I did that recording, that presentation, we haven't budged. We saw a drop off, and now we have resumed the uptrend. The Federal Reserve needs to pull liquidity out of the market. They haven't even begun yet. And what Powell was doing on Friday, he was telegraphing, get ready, it's going to come. In all probability in September. They said this was going to happen in June. That never really materialized. The one thing that did materialize was that a trend developed. And this is the careful calculation of the Federal Reserve. You could see that we peaked out here in April. And ever since April, we've been putting in lower highs and lower lows. No real major declines in the hundreds of billions of dollars that we were assured we were going to get going into the summer. But the trend is now established. And if he follows through on a reduction of the balance sheet in September, folks, it's going to be a profound impact on equities, a profound one. So he's only done 2 or 3 major rate hikes since February. And he hasn't even gotten the Fed's funds rate up halfway near where the inflation target should be. Paul Volcker back in 1981 brought the Fed funds rate. For those not familiar with the Fed funds rate is, it's the cost of a bank borrowing from the Federal Reserve so they could loan it out and make money. He brought the Fed funds rate up above the rate of inflation. That's how we killed inflation. We're nowhere near there, nowhere near it. So even though all of the fear has been priced into the market about the Federal Reserve's hawkishness and their rate hiking to fight inflation seriously, they have not yet begun to fight. And that's the point I'm trying to drive home here. And if you're wondering what caused this bull market over the past 15 years, it's this chart right here. If you overlay this chart over the S&P 500, they're lockstep. They go up together. So what happens when this rolls over? Well, the S&P 500 goes in lockstep, downward. So I titled this live stream, Jay Powell setting us up for a stock market crash. Yeah. Yoga Mac. I had a brain stump. is equities real estate or pensions or something else? Equities is purely, in my vernacular, purely stocks. Nothing to do with real estate. Pensions do invest in stocks, so um, be careful with, if you have a pension and it's overly invested in equities, especially Chinese stocks. Okay, so let's talk a little bit about. Oh, by the way, since that time frame, Bitcoin, I recorded it here. We corrected 61.5%. We're off those lows, but over the weekend, we have broken down and we continue to weaken up here. We have a continuation breakdown on the week. If you're dollar cost averaging small on Bitcoin, fine. I'm going to have my $50 per week go in tomorrow. It's not going to change. But if you're big on Bitcoin, Bitcoin's going lower. It's going to go a lot lower, especially if equities roll over. There's a 75% correlation between Bitcoin and equities. As go equities, so goes Bitcoin. Case closed. So please be careful. All right, economic data coming out. What's tomorrow? 29th. Tomorrow, nothing. Tuesday, Case-Shiller Home Price Index, consumer confidence, big number. Job openings, expect them to come in lower. ADP, first time ADP report is going to be reported in several months. That means that on Friday, we get non-farm payrolls. Let's see if they manipulate these numbers like they did with the jobless claims the other day. Average hourly earnings, factory orders. We're going to have some Fed heads, Bostic coming out twice, as if we need to hear from him. We're going to have another revision to the manufacturing CPI, PMI, Purchasing Managers Index. Any read below 50 is a sign of contraction. Any read above 50 is a sign of expansion. We are already in contraction on services. Now we're going to get the PMI final for manufacturing. Last read was still in expansion. Moving on, valuations of the market. We remain overvalued, folks. We remain overvalued. So we remain 43% above the historic fairly valued trend line, or a 1.2% standard deviation move. The Shiller, we may come back to this later on. Shiller PE ratio still above 30. Still above 30. Earnings this week that we'll be trading. Not much, maybe CrowdStrike. Earnings are really slowing down dramatically. Broadcom, Lululemon, maybe. But that's about it in terms of earnings. You have a lot of Chinese stocks coming out this week. I do not trade Chinese stocks. I strongly suggest that you do not either. All right, so to the Qs, and this is the question that was asked by Seymour Rivers earlier in the session. Here's what I had to say on Thursday night's Futures Live. And if you're not subscribed to the channel, I go live Sunday nights and Thursday nights. Join us. Click the subscribe button and the bell button. Get notified when we go live. Here's what I had to say on Thursday night, this past Thursday night. The triple Qs. Now, closed out the day yesterday, 1 penny above 315, which is critical support. I booked profits, half profits on our short. But what I'm waiting to see here is this. On a weekly chart, is this week a retest of a breakout point and we close above this support level in blue? If we do so, that probably means we're going to see higher highs next week. If we fail to hold support tomorrow and we close down below 315 on the triple Qs, I'm going to load back up on shorts on the triple Qs and expect new lower lows. Okay, so that was the call on Thursday night, and let's fast forward to the end of the business. And this is why I say every Thursday night when we go over the weekly charts, one trading day left to go. And by far, this was the most dramatic change from a Thursday night to the end of business on Friday change I've seen across the board on pretty much every single chart. Weekly chart, this is not the one I wanted to use. Go to the same exact one. There we go. So remember that we had a bullish reversal bar on Thursday night. Actually, it wasn't a bullish reversal bar. It was a down week, but it was a reversal bar nonetheless. Now we have broken down. We have a continuation breakdown. This is a bull trap, also known as a breakout point failure. What does that mean? Well, we had this massive rally, peak to trough or trough to peak of about 25% on the triple Qs. We broke out the week of August the 8th. The following week, we had a continuation move lower. What do we have above? I kept calling them zombies above, dead bodies above, also known as overhead supply. You needed to expect that people that have been waiting to get their money back were going to press the sell button. So that's exactly what happened. The however is that we held support. Last week, however, we broke down, and Friday was just a mother of a day. There was like hardly an uptick all day long. So yes, we did go adding slightly to the Q short position. I see somebody put out here, put position, iron. Hopefully I'm saying that right. Put options time. Yeah. So what we did is the trade on the Qs is not shorting the common stock. It ties up too much capital. We focus on return on capital. And the best way to get a return on capital with the short of the Qs is to use what you call a bear put spread. What does that mean? Well, we don't buy deep out of the money puts here, except I did on accident on Friday, to be honest with you, completely by accident. What you do is you buy a deep in the money put option with a 70 delta. 70 delta means it moves 70% along with the underlying value of the stock. So if the stock moves $1, the option moves 70 cents. Simple as that. So that's a 70 delta. Simultaneously, we sell a deep out of the money put to help finance the trade. It caps our profit, but it helps finance the trade. That lets me sleep at night, and it helps offset the time decay. So that's the strategy here. We added to it. Now, if we rally back up into the range I have set is 312 to 315. If they rally up into 312 and 315, I'm going to lean in heavy to the short side on the triple Qs, unless, of course, you're seeing oil crater, natural gas crater. If I see deflationary events occur, I will not short the triple Qs. In fact, I might consider covering the position, because traders will interpret that as being a reason as to why the Federal Reserve need not be so hawkish, if that makes sense. Hopefully it does. So long story short, we're bearish, and I think these go lower. All right, so what did Powell do on Friday? Powell warns of economic pain from tightening, says historical record cautions against loosening policy prematurely. Surely, he's right. The historical record is clear. You got to kill inflation, or else you kill your society. The problem is that while he's talking about loosening policy, he hasn't even really begun tightening. Here's M2 money supply. This can't be argued away. Here's the Fed's balance sheet. This can't be argued away. Inflation was transitory a year ago. It's been embedded into the economy ever since. The Fed's balance sheet has hardly budged. So be careful with we've seen the big sell-off in equities. God forbid this guy starts getting serious about inflation and takes action. Am I stuck here? Okay, good. All right, so these are the bullet points I agree with. Powell, and these are bad statements. Powell will likely require restrictive policy for some time. Equities hate that. Hate that. It's a reason to sell right away. Powell, history cautions against prematurely loosening policy. Any talk of pivot, for right now anyway, is off the table. He took that off the table. Powell, inflation has just about everyone's attention right now. This is going to politics. Midterms are coming up. They got to get a handle on inflation. The longer the current bout of inflation continues, the greater chance that expectations of higher inflation will become entrenched. People stop spending, companies stop investing, and the entire economy goes to heck in a handbasket. He's got this right. I have to agree with him. Moving on. We already did this. A vicious stagnationary environment awaits. Folks, this is why, if people ask me, Bob, why are you so wed to the gold trade, to the gold mining trade, to the silver trade, to the commodities trade? What gives here? It's stagflation, folks. It's the greatest environment for gold and the miners to do amazingly well. The only problem is that the US dollar has been very, very strong, but the ECB, and this is what I mentioned to members on Friday morning, forget about Powell. We knew this was going to come. Focus on the ECB. They may be raising interest rates by 3/4 of a basis point in September. Unheard of. We are not the only major economy that is raising interest rates now. The ECB is. Switzerland is. It's not a major economy, but they're raising rates. Japan, not yet, and they're not going to for a long time, and they don't have to. They have net exports. They're a creditor nation, so they're just fine. They have savings. So the Europeans are raising rates because they're worried about their elitist hold on the government. They have to jack up interest rates to get energy prices down. So what does that mean for the US dollar? It's not good if the euro catches a bid. And Friday morning, the euro ripped up higher. Ultimately, it faded, but it's just an inkling of what's to come with the euro. I think the euro is just about at bottom. And if the euro bottoms out, in all probability, the dollar's peaked out. Mining stocks. In a similar concept, the historically undervalued energy companies continue to be. Other commodity businesses may offer an even stronger proposition. Mining stocks. We bought more mining stocks, actually options, on Friday. For instance, are currently trading at multiples not seen since their historically most depressed levels. This is a function of falling stock prices coupled with strong fundamentals. The PE ratio for metals and mining stocks in the S&P 500 are now resting at lows of the 2008 bottom. Here's the chart, folks. 2008 bottom, then we got the rip. We are here. So for those folks thinking about dumping their mining stocks, that's not the contrarian thing to do. On that sell-off on Friday, we were buying, at least options anyway, we were buying more of the mining stocks because we think that the market had it completely wrong. They're not getting the fact that the euro is about to bottom out and probably move up higher because they must raise rates. Inflation on the energy front in Europe is much worse than it is here in the United States. Remember, within Saudi Arabia of natural gas. Moving on, natural gas. What did we just show you with natural gas? How did it open up? Let's check back in. Here's natural gas. Up now, since we last spoke about it, it only gained up now by nearly 3 1/3% in 50 minutes. Crazy. So natural gas sends strong message. The surge in natural gas prices to recent highs is perhaps one of the most Important developments unfolding in the macro environment today. It's happening right at a time when inflation narrative has dissipated due to recession fears. The appreciation of natural gas reminds us that commodity markets are fundamentally linked. Rising energy prices often drive rising agricultural and material prices. That is built-in inflation. And you're seeing it in ammonia prices. Couple this with the most erratic energy policy in history. In case one thinks that the selling pressure in oil has been solely driven by recession fears, the U.S. government has sold another 27 million barrels last month. At that pace, the strategic petroleum reserves will be zero in 18 months. The demand deterioration in China, the Chinese economy, and the U.S. government selling its strategic petroleum reserves, one would think oil would not be trading anywhere close to as high as $90 a barrel. Such strength in this price speaks to the overall supply tightness in the energy market. We believe oil is headed substantially higher. They're right. They're right. The bear market is over, or is it just hibernating? Now, I know Ryan Tetrick. He's a CMT charted market technician, smart guy, and I have a lot of respect for the CMT folks. They're very, very good people, very intelligent people. I go to their convention. But I kind of disagree with him here because I think that he's not thinking macro. He's thinking, you could think technical for your timing of a trade, but you can't take your eye off the macro, the geopolitical views of the market. And I think Ryan here I'll take issue with him basing his feel that the bear market is over based upon the fact that you have 90% of the components of the S&P 500 are now above their 50-day moving average. So what? So I can't buy into his argument that the bear market is over there. I buy more into the argument by Doug Cass, and Doug Cass follows me. I follow him on Twitter, and I've always been a big fan of his. My colleague Doug Cass recently made an excellent point. I'll skip the top part and go to the bearish part. Indeed, the swiftness and the size of the rise in equities last month have recently driven markets back to valuation levels that concern me. That's why we do this show every Sunday night. We talk about valuations so we don't take our eye off the ball. We got to keep our eye on the ball. We are here, overvalued. We are 1.2 standard deviations beyond, also 43% beyond historical average. It's only going to get worse. Reducing the general, driven back to valuations at the same time, reducing the general attraction of equities and posing the risk of more negative outcomes to stock. Couldn't agree with him more. The recent passage of the Inflation Reduction Act will increase taxes on corporations and households. This is your government not at work. This is your government taking a shotgun while in a rowboat and blowing holes in the bottom of it. This is what our government does. Such will reduce the growth of profit margins along with stubbornly high inflation. The markets are pricing in roughly, and this is where it gets hairy, folks. If you think the market's expensive now, listen forward. The markets are pricing in earnings of roughly $214 per share on the S&P 500 by the end of 2023, down from $242. So they've already brought in expectations. However, if the Fed continues its fight against inflation and triggers a recession, earnings could drop to $188 per share. At a generous forward multiple of 18 times those earnings, you are looking at a market calculation of 3,400 on the S&P 500. We closed out the session on Friday at 4,057. Their price target is down here. That means that we have seen if they're accurate, and I do believe they are accurate, we have seen a bear market rally. We will break down to new lower lows. And here's their price target. I think we overshoot and we come down here to these support levels at around a 32 handle on the S&Ps. And that is where we put the next counter trend rally in. Hardly even growth stocks anymore. Now, we're short the Qs, and here's the proximate reason as to why. Besides their inverse correlation or their sensitivity to the rise in interest rates, the 10-year yield. In contrast to what most investors believe, the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, stocks are starting to show serious signs of weakness, correct, in their fundamentals. The median real revenue growth for these companies has officially turned negative for the first time in almost 20 years. Interestingly, investors still consider them growth stocks despite their meaningful exposure to a cyclical downturn in the economy at large. I just got these shorts. That's why they keep doing that to me. We are here, folks. FANG revenue real growth, negative. I'm afraid Czech president blames green madness for energy crisis. Great point. He's so on point. Moving on. Christine Lagarde, European Central Bank, blames climate change for red hot inflation. She is one of the loons that this guy is worried about. Elsewhere on Thursday, Lagarde was asked if she feels any weight of the responsibility that her decisions have had on the lives of Europeans. Oh, yes, absolutely. I still buy my groceries at the supermarket, pay my own bills, blah, 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 blah. As life here at the ECB can be more removed, disconnected and punctuated, but with economic metrics, sorry, I can't read, models and projections, I move forwards with a sense of duty and humility, she responded. So with the duty and humility that she feels to do her job in accordance with her mandate and help the European Union and the citizenry, she believes that the crisis that is going on over in the EU is blamed on climate change, either delusional or corrupt, both, doesn't matter, she's got to go. The proximate reason as to why the ECB is in so much trouble, besides the Ukraine, is this. This is their version of our Fed's balance sheet. Here you go. This is not climate change. This is them printing money, just like we've been doing. You know what the top search term is in Germany right now on Google Trends? Brennholz. Brennholz. Brennholz is the German word for firewood. Pretty much flatlined for 5 years here. Now it's gone parabolic. In Poland, this is beyond imagination. Polish homeowners line up for days to buy coal ahead of winter. Folks, these globalists, they are looking at a citizenry that are going to be in the streets with pitchforks. That's why they must raise interest rates to try and kill inflation. They'll do it for their own survival. Will it work? I doubt it. They got to go. By vote, of course, but they've got to go. To the US dollar and why we are so steadfastly sticking with the gold trade. The end is nearing, a world slowly opening, openly turning away from the US dollar. We've spoken about this. I was screaming on one of these live streams back when we threatened to take Russia off the SWIFT system and to seize their U.S. forex reserves. I went haywire because we took a gun and not only shot it in the bottom of the boat, but we took it and we just put it underneath our own shins and we just blew our head off. The only reason why the American people have been able to live the lifestyle that we have for all these years is because we have been the world's reserve currency. We have been able to export IOUs and take in goods. Simple as that. The new normal, open dishonesty. I don't think anybody could argue that. They manipulated the CPI data, official unemployment data. The CPI data being manipulated means that it's not the same as it was calculated back in the 1970s and 1980s. They use hedonic adjustments, owner's equivalent rent. It's completely different. If you use the 1970, 1980s model of the CPI, inflation would be double, much higher than what it was in 1981. They've redefined recession. And you have a president that says we saw 0% inflation in the month of July. Not year over year, but the month of July. So you have, it's not even intellectual dishonesty. It's just, they're just dumb. They're just dumb. You know, any reasonable person with half a brain realizes that inflation did not go down in the month of July. Set the stage narrative for a Fed pivot. What the July CPI declines does achieve, however, is yet another headline myth to justify an inevitable Fed pivot, meaning Fed becoming more accommodative, printing money yet again, allowing stock prices to move up higher. I question this. I was in this camp. I'm not so much in this camp any longer now anyway, because I'm more worried about Germans typing in their top keyword is firewood for warmth, and Poles standing in lines to get some coal. And it's only going to get worse. So I think that fear of the citizen is going to outweigh the need to prop up equity prices. Just a thought. I could change by next week, but that's where my head is right now. China openly mocking the U.S. dollar and backfiring Putin's sanctions. The opening backfiring, financial inept, and politically arrogant Western sanctions agreed 1,000% against Putin's war amounted to the biggest game changer in global currency system since Nixon closed the gold window in 1971. That, in fact, was the date that was the beginning of the end of the U.S. as a dollar reserve currency. More to the point, and despite massive capital outflows, the renminbi or yuan, I should say, it's the offshore yuan, is remaining strong because of its FX reserve, i.e. the amount of savings that they have are actually rising and not falling. Where is the money coming from? Answer, just about anywhere except the dollar-led West. That is, nations like China and Russia, who have been chomping at the bit for the last decade to de-dollarize, are now doing precisely that in the wake of recent moves by the West to weaponize the U.S. dollar by freezing Russia's FX reserves. I said this months ago now, that this was going to come back to haunt us. It's coming back now. It's now being spoken about openly. Myopic sanction chest puffing by the West has given the East the perfect pretext to fight back financially and monetarily, and they are fighting back to win a heating currency war. And here's what it all comes down to it, folks. From petrodollar to petrogold. We're currently on a petrodollar system. They're going to petrogold. In other words, Turkey could be dumping U.S. dollars to buy gold at what we would know is a deliberately rigged COMEX. You wonder why gold is not moving higher? Wondering why JP Morgan bankers are going to jail? They manipulate the COMEX. Turkey can then sell gold to Russia's central bank in exchange for rubles at a negotiated price otherwise needed to purchase Putin's oil. Folks, before Ukraine, a few years ago, Turkey would have gone to the dollar markets, bought dollars, and bought Russian crude with US dollars. That's done now. That's gone. And it's only going to get bigger. Given the physical oil market is 15 times the physical gold market, one can only imagine what further oil for gold transactions as per above will do for the rising price of the scarce asset like gold. Want to know why we're holding on to gold physical? This is it. This is it. Yoga Mac brought up the digital dollar. Watch out for the digital dollar. Please look into it. They've been priming us. Okay, I'm with you. So here we are, the new status of the digital dollar. In blue, research mode. In green, launched. I want you to take note of something, and this is really the only takeaway that I want you to take away from this illustration. Take note of the countries that have adopted the digital currency, the digital ruble, digital renminbi, whatever Kazakhstan's currency is, South Africa, Saudi Arabia. What do they have in common? What do those countries have in common? This is from the Heritage Foundation. The only country that is, this chart here is country rankings, basically for human rights. Free. None of those countries are up here. Mostly free. None of those countries are up here. Not really free. The only one that's up here is Kazakhstan. Everyone else is either mostly unfree or repressed. The takeaway from this is that the digital dollar, the digital whatever, is only a form of control on the citizenry. They don't like you, they take your money, they cut you off. You're not spending your money quick enough, they tax you. That is the future. There's legislation now in Congress, and it's bipartisan. Democrats, Republicans, they're on this. They're trying to push it through. You got to call your congressman, senator, tell them, we're watching you. We see you. Do not vote on this. Do not vote on this. We do not want it. We want physical cash. I want cash, pal. Let's do some comments. You're so right about mining stocks, Bob. Went all in on both uranium and silver mining stocks back in July. Yeah, it's been volatile, but it's a macro trade. Yeah, I'm with you. Liquidity contracts deals you have are going to have machine learning and data analytics, basically AI. Yes. All right. gotta love Bob. Doesn't matter. She's got to go. They all got to go. By vote, not by violence. Okay. All right. Bob the Magician. Thank you. Thanks everyone for being here. Let's do some chart because I was going to go over the rule of 20, but I don't have enough time. It's already past 7 o'clock. I'm going to do a separate video on this. And I'll share this with you. I don't want to leave you with a tease, but if you're looking for a way to measure when it's time to buy equities, this is a great article. And I honestly forgot all about this. It's been so long. But I'm going to do a video about it because nobody's talking about it. It's the rule of 20. It's how to measure in a inflationary environment when it's right to go buying equities. And I'll save it for a video, but read that at your leisure. Zaki, is it too late to buy puts? No, it's not. I don't think it is. I think that if you rally back on the cues, you hit those resistance levels and you break down to new weekly lower lows. It's just the market validating that the path of least resistance is resumed to the downside. So I would just argue. I entered my short position when the rally was just hitting resistance levels. So we got in very, very favorably, and I got the options very, very cheap. The implied volatility was very, very weak. So just watch out for the implied volatility. If they get to be too expensive, then you got to worry about an IV crush. And if you don't want to buy on too much weakness, those put options, because if you get a counter trend rally, the implied volatility gets sucked out of the options. So you lose both on the intrinsic value and on the extrinsic value. So just be careful. John Yates, I bought puts when Dow was down 500 and made good profits. Cool. Good job. Congrats on the trade, man. All right, let's do some chart requests. I don't know if anybody asked for any. I know I didn't see any in the members area. Let me refresh, make sure. Nothing there. Do we have anybody in the chat? X, USO X. Let's do it. Oil. This is a weekly chart. It's going up. It's going up. We broke out. We broke down here the week of August the 1st, recaptured support. We're consolidating. We're going to have a bit of resistance immediately above here at around $79 on USO. We closed above that mark. I think that we head up higher. You're going to have more resistance up here at this volume shelf at $91 a barrel. Excuse me, $91. I keep thinking the barrel futures on USO, $91 per share. Stokes are now hooking up. RSI is now hooking up. We can consolidate a bit more here, but I think that we're going up higher on oil prices. U.S. steel. I haven't looked at this one in a while. This is an interesting one. Folks, we're using TrendSpider automated technical analysis, 35% discount code below. Steel last week, a outside reversal bar, also known as a bullish engulfing, meaning it engulfed the entire price move of the prior week, which was down. Last week was up. Very solid chart here. It looks as though steel wants to move up higher, and a bullish reversal bar and an outside reversal bar. One of my top 5 favorite candlestick patterns, link below, free 5-part video tutorial. So U.S. steel wants to move up higher. If you're looking for a spot to go buying, I'd say $25 a share. RSI, higher lows, Stokes rising. Daily view. A down day on Friday, and this is the value of the automated trend lines. This line in red, I did not draw it. That's the algorithm. Let's take it off. Here it is. Take it off. Now I put it back on. We broke out on Thursday. We failed to hold the breakout point on Friday. That's bearish. So what I would do here is either wait for a retrace back down to $24.80 per share, or a recapture of 20, let's call it $25.60 per share. Then I would open a position. You could buy down here, add more on a breakout, but I don't like the price action on Friday. It implies that we're probably going to see lower lows. The weekly chart's more bullish, so I give more deference to the weekly chart versus a daily chart. This is simply a reaction to the market move lower. It doesn't mean it's going to be meaningful or long-lasting. So longer term, I like U.S. steel. Love the show. Thank you very much, John. Appreciate that. UNH for Zaki. United Health Group, outside reversal bar on Friday, or bearish engulfing. This is going down. This is going to go lower. Probably down to these moving averages. I wouldn't short it yet. Oh, this is really long in the tooth here. Let's go to a monthly chart. Yeah, Zaki, you're going to have support down here at around 522 per share. I would wait and see whether or not that holds. This is a bearish reversal bar on the week last week. and on Friday. In all probability, we're going to see lower lows here, and you could, in fact, have a double top. And this is a potential megaphone formation. Be careful here. Be careful. I don't like the chart. Dixie on a Sunday is robbing America's wealth pricing and inflation. There goes all of the last 4 weeks' gains. Okay. Tesla. Tesla split. I think the buzz is gone out of Tesla. I don't like Tesla. I think it's probably going to head lower. Bearish Q reversal. Let's get rid of this. Bearish reversal bar. We're going lower. Take note of all this topping action above. I think that if we break down below 280 and close there, we're going a lot lower. We're probably going to take out the lows of May. So big warning flag on the track for Tesla. Folks, thank you. Thank you for being here. I really appreciate it. I hope everybody had an awesome weekend. Have a profitable trading week. Like, subscribe. TrendSpider 35% discount code below. Help support the channel. If you want to join the Contrarian Trader, 14-day free trial offer. Silver and gold level members get TrendSpider for free. Join up. And I will talk to everyone throughout the week. Be well.